I got a really interesting question from an OG of the channel, and the question is, what would you do if the share price collapses for a stock that you had a cash secured put on? How do you sort of think about that situation? And so that's what I'm going to cover in this video by speaking to a hypothetical example of Alibaba stock crashing while I've already publicly made available that I have a cash secured put on the company. And so guys, as you smash that like button, let me run the intro. What's up guys, and welcome back to the channel. Now, the first thing that I would say is that ask questions in the comments to all of these videos. At the very least, I respond to you in the comments, and at the very most, I might highlight one of your questions because I feel like a lot of people would have the same question. And so this particular question is something that I deal with all the time as I manage my portfolio. Sometimes I just have straight long positions on stocks. Sometimes I have cash secured puts. Sometimes I have covered calls. Sometimes I have straight option type positions, which is what I did on the Activision deal. And so it really depends on what the situation is, but we have a lot of these quivers that we can use and utilize in specific situations. And so let's talk about this particular question as it relates to cash secured puts. So Paul, he's an OG of the Patreon. He's been with the team of 200 plus Patreon since May of 2022. And so it's been almost a year now. And you know what I'm going to do? I'm going to start, I'm going to create like a club for you guys. So like people who've been on the Patreon for over a year at least, you'll get some additional perks and benefits just for being with the team for that long. And so I'm going to think about it, but try to provide something extremely valuable to people who've been on the Patreon for this long. And so his question was, there are times where a stock I've sold puts on dips below my strike price, but well in advance of the expiration date. Have you faced this decision yourself, and what have you done? And he does say that he sells only cash secured put stocks that on stocks that he wants to own, and the income derived from the put is an added benefit. So the first thing that I want to say is that's absolutely perfect, Paul. That's how you should be looking at cash secured puts. You should only sell cash secured puts for strike prices, or at least net purchase prices, in the amount that you're be comfortable owning the security. You shouldn't be selling cash secured puts as sort of like a income generation thing throughout the life of your portfolio. The reason why I say that is because you never know with respect to the volatility of the securities markets, whether or not you're going to get exercised or not. And so the whole point with cash secured puts is to enter into positions at prices you're comfortable with, not to generate an income. The income that you generate is just an added benefit. In other words, it's compensation for you to tie up your capital in the event that you do get assigned on that security. And so I'm glad that you're looking at it from that perspective. Now let's get into your bigger question. What do I do when the share price declines significantly well before the exercise date? And before I get into the Alibaba example, the first thing and the most important thing that I got to make you aware of is that you can get exercised at any time, or you can get the shares assigned to you at any time. And so what you have to be careful of is make sure you always have the cash available in the account. That's why I call it cash secured puts, and I don't call it just selling puts. So make sure you have that capital available. There have been many times where I've been assigned before the strike date. So if you don't have the capital available, do not sell a put. Now let's get into that Alibaba example. So you can see here that I'm going to answer the question using the public example of the Alibaba position that I doubled down with. And you can tell, I doubled down in around April of 2022. And so you can see that the shares have declined significantly, then they've increased significantly, then they've declined, increased, and now they're back on a decline. So, it's just really been a roller coaster ride for us. And so as you can imagine, for most of this time, I've been underwater as it relates to the exercise price to the strike price that I agreed on purchasing it at or selling it at. And so what I did was I went back and I found the video where I doubled down. And so here's what happened. So the video came out on April 21st, 2022. The share price at the time was $86 per share, and the exercise date for the security was January 19, 2024. And so the strike price was $100 per share. So as you can imagine, because the stock is $86 per share and the strike price is $100 per share, this was an in the money cash secured put. And so the premium was a little bit higher at $30 per share, but notice that the net purchase price was $70 per share. And I could tell right away just from here that this would be a position that I'd be interested in because the annualized yield is around that 17.5% that I like to target with cash secured puts. And the net purchase price is around $70. Now, when I think about Alibaba, I look at the stock as, approximately a $10 free cash flow per share stock. And so 10 divided by 70 gives you a pretty decent yield. I think that's around 14% annualized. So worst case scenario, I'm generating a 14% free cash flow per share yield, which is phenomenal as far as I'm concerned, as far as my portfolio is concerned. And so, I have some rating here. So, at the time when I doubled down on Alibaba, I used the in-the-money cash secured put, which allowed me to capture a bit more premium, but it also increased my net purchase price, which is true. Options trading is all about optimization between downside protection and yield. So your downside protection being the net purchase price and the yield being your annualized yield. I always prioritize downside protection, so I was comfortable with a net $70 purchase price while optimizing the yield. Of course, I could have had a lower net purchase price, but the thing about it is at the time I'm valuing Alibaba at approximately $200 or just over $200 per share. So if I can purchase that at a net $70 per share, that's totally fine. And once again, I said, I look at the stock as around a $10 per share stock on a free cash flow per share basis. So 10 divided by 70, it's a really good equity yield, even if I do get assigned. So heads, I make 17% on my money. Tails, I get assigned and I perpetually make 14% of my money if the stock price remains suppressed to perpetuity, and the company, of course, continues to buy back shares. So no matter what, this is a good investment opportunity, and which is why it makes a lot of sense as to why I doubled down on it. And I actually had to go back and research the thesis as to why I doubled down on it, because it's been so long since I've done it. And I've, of course, I spend most of my time trying to research and figure out what the next capital deployment is for the portfolio. I really don't go back and look at the thesis as to why I entered into a position previously. I write it down, but I don't really spend a lot of time thinking about it. I just sort of think about what am I doing next, and how am I addressing certain things that are coming up with the portfolio as time goes on. So for example, if Alibaba is now coming due and it looks like I am going to be assigned, how am I thinking about that? That's the only time I look back and see what the thesis was. And so that's what this is, the thesis. And so as you can imagine, because I sold it in the money, and the put was so much higher than the share price, the in the money exercise price $100 is here, whereas the price at the time that I sold it was here at around just under $90 per share. I was already likely to be exercised, but I made a bet. I felt like it was more likely than not that the share price would run upwards once the country reopened, as opposed to declining further. And even if it did decline further, which was very much a likelihood, I was fine with the $70 per share cost basis, for the reason that I just told you, that it was a $10 per share free cash flow per share stock. And I don't want to just tell you that, I want to illustrate it using the model that you guys have access to at that lower tier of the Patreon, so you can see that you kind of have to just get rid of the I've lost because I got assigned mentality with CSPs. Remember what your thesis was to be comfortable with the cost basis. My thesis was that this is, on average, it's going to be a $10 plus free cash flow per share stock, and I'm able to buy it at a net $70 per share, which reflects a perpetual 14% and increasing equity yield if the stock price never recovers. And that just means that the company's just buying back shares while continuously increasing the free cash flow per share amount that it's generating. So your equity yield gets higher every year. And of course, the stock price would of course recover, because eventually you're going to get to like a 20% and greater equity yield. So it doesn't make sense. So in other words, this is a very advantageous position to be in, as you almost hope that the stock price never recovers and you do get assigned. And so over time, the company just buys back more and more shares. And so your equity yield just continues to increase. So, what I did was I just went back and looked at the thesis, and the thesis is largely the model, right? And so, in 2023, I'm not going to get exercised, but in 2024, I'll get exercised. And, if I do get assigned, well, the company is expected to make around $8 per share that year. And then in 2025, it makes, $10.50 a year. And then thereafter it goes higher. So, if you want to look at it with the average of like the next 5 years, it's a much higher than even $10 per share equity yield. You're probably looking at 17 per share of equity yield, but I'm just being conservative by saying $10 per share. And so let's wrap this up in a nice bow. So what would you do if the share price dips below your strike price and or your net purchase price as it relates to cash secured puts? Well, the first thing I would do is I would leave the cash set aside to be assigned at the net $70 per share price, and I would look to double or triple down again, because if the opportunity was good at a net $70 per share price, how great is the opportunity at a net $50 or $40 per share price? Or do I just buy shares at this lower price? And so if owning the shares at a net $70 per share is a great deal, considering the equity yield is 14% and greater, what would the equity yield be if I can sell a CSP for a net purchase price of $40 per share? And the answer is 25% if you look at the stock as a $10 per share stock. But like I said, the equity yield is growing. So the longer out you look, the higher the equity yield is expected to be, right? Nothing's for sure, but that's kind of the way that I think about this. Look, I'm a business owner. I'm not an investor that's looking to buy stocks low and sell them high. I'm looking to own the business into perpetuity. And so if you sort of just like change your mentality to that perspective, you don't really care if the stock market is open or not. Listen, as soon as we sell that option, or as soon as we get exercised on the security in itself, so as soon as we own the stock, it does not matter what the stock market does. I mean, it does from the perspective of what price is the company repurchasing the shares at, but essentially you see what I'm trying to say, that our focus is really, is the company going to operate it from the way that we've modeled them out to operate in? So this is more of an operational situation now, as opposed to sort of like a let's buy the stock low and sell it high and focus on our stock returns. The real question is, let's focus on the company's operational capabilities and what is management doing to derive value for us as the owners of the enterprise. And so really what I'm trying to say there is, I don't even consider myself a value investor. I consider myself a business owner. And there's some key considerations that you guys got to take into account. The first thing is, before you double down, always, is the story still the same, or did the stock price decline for a particular reason? Are you still appropriately diversified if you do double down? One of the reasons why it took me so long to double down on Alibaba in the first place is because I just need to make sure that the position allowed me to remain appropriately diversified, even if I got assigned on that double down position. And so, I preach diversification on this channel. I know that some of the greats don't agree with me on diversification, and that's okay. We can agree to disagree on that one. The next question is, do you have the capital available? Like I always say, put the cash aside. Do not sell puts without having the cash available. You're entering into a risky position that you don't need to be in. And then finally, are there better opportunities available? One of the things that a lot of people don't think about is, just because you are potentially in a loss position on one stock doesn't necessarily mean that there aren't great opportunities somewhere else. A good example was, I spoke to you guys about the opportunity with Meta when the shares were trading at around $110 or $120 per share, and they've run up as of the recording of this video to almost $200 per share. I didn't participate in that situation because I had found other opportunities that were more exciting to me at the time. And so just because Meta looked cheap at the time doesn't necessarily mean that there wasn't something else that was better. And so you need to sort of like use that sort of like same mentality, even as it relates to positions that you hold in your portfolio that are currently showing a loss. Do not get caught up in that, let me double down so that I don't see a loss in my portfolio anymore. It shouldn't matter. You buy the value. And so the price that you bought the stock at, that's all that matters. And then in your mind, you're like, listen, this is the long-term equity yield based on the price that I paid. And that's the only thing that matters. And so all you got to do thereafter is focus on the operational capabilities or the operational progress that the company is making, nothing else. The temporary losses that you're seeing in the portfolio, who cares? Now, I do a lot of research, guys, and I make it available for you. Now, I make the research available not as a buy and sell, but more of like a how you should be valuing the company out, and sort of like what am I seeing and how I'm forecasting the results forward. And you guys are free to disagree on those assumptions, but if you want to get access to all the models that I make available, you can get access to it at this lower tier. And if you want to join us on an epic live presentation every month, you can join us at that upper tier. And so far, I'm very humbled where over 200 of you guys have decided to join us on this adventure, and so it's great. And this is of course the Q&A series of the channel, and so if you've missed any other of the Q&A videos, I think they're all very helpful. And so if you want to get to the other Q&A videos that could really help you with your portfolio or your investing in general, get access to the whole series right here.